Welcome to the March 21st session of the Phoenix Congress, where we are writing a blueprint for a better America. This legislative package will end poverty with a universal basic income, end mass incarceration with major criminal justice reform, and end the endless wars by bringing our troops home and reducing our military budget. Today's session is the 19th of 21 public hearings on the 2022 legislative package, and we will review sections 451 to 455 relative to the value added tax. These sessions will conclude this Thursday and next Thursday at 1:30 p.m. Eastern. For those following along at home, you can find a link to the legislative package in the description below or at bit.ly/B, lowercase dropped box. If you have questions about today's sections, you can submit them in chat. And if you'd like to offer questions or other testimony for future hearings, please use the link in the description below. Before starting, I'd like to invite you to join us in reciting the preamble to the Constitution of the United States to remind us of our duties as Americans and set the intention for what we are trying to do today. We, the people of the United States, in order to form a more perfect union, establish justice, ensure domestic tranquility, provide for the common defense, promote the general welfare, and secure the blessings of liberty to ourselves and our posterity, do ordain and establish this Constitution for the United States of America. With that, I'd like to welcome the delegate from North Carolina's 9th District to continue his testimony on the blueprint for a better America.
Thank you, Mixed Chair. For the record, my name is Brian. I'm an organizer with the American Union and a Phoenix Congress delegate in good standing, representing North Carolina's 9th District. Today, we're covering Subtitle E of Title IV. This is the value added tax. It's a complex issue. The nuances of tax policy, they're not as sexy as some of the other issues in the blueprint for a better America, but they're important parts. And so section 451 is the findings and purpose. I'd just like to start by reading the findings into the record and then talk about it in general. So subsection A, Congress finds the following. 1, the utilization of America's productive capacity has trended downward over the last 50 years as wages has not kept up with increases in productivity. The issuance of Treasury dollar bills will enable an increase in purchasing power and drive further economic development by bridging the gap between wage income and productive output. 2, issuing Treasury dollar bills in sufficient quantities to end poverty will free up additional resources that are currently being diverted to address problems spurred by poverty, such as crime and increased healthcare usage. However, these quantities may cause inflation beyond normal targets. Therefore, some of the increase should be taxed back or clawed back to remove it from circulation and fund government expenditures without borrowing money at interest. 3, wealth inequality distorts the marketplace and decreases the quality of life for citizens. A value-added tax, or VAT, is a consumption tax. Those who spend the most will pay the most. When it's combined with universal basic income, it is a progressive tax. 4, a 2011 report by the Congressional Research Service concluded, the imposition of a VAT would cause a one-time increase in this country's price level, but a VAT would not necessarily affect the country's future rate of inflation if the Federal Reserve offset the contractionary effects of a VAT with a more expansionary monetary policy. 5, the United States is the only member of the Organization for Economic Cooperation and Development, the OECD, without a VAT. In subsection B, the purpose of this value-added tax is to address wealth inequality while clawing back some of the increase in the money supply. So value-added tax is a very common tax around the world. I think more than 90% of countries use it, some form of a value-added tax, because it's generally a very efficient tax at capturing a slice of the economy. In recent years, it was popularized by Andrew Yang, who brought it up as a potential funding source for universal basic income. And that is sort of the mechanism that we're using it for in the blueprint for a better America. As the universal basic income puts money out there, the value-added tax can claw some of it back and address wealth inequality. So This subtitle will establish a 12% value added tax. That is much, much lower than the European average, but will still raise, will bring in significant amounts of revenue for the United States. And really, the value added tax, it raises a larger question of what is value? How do we define value? And so for the purposes of taxation, value is the difference between whatever the raw inputs are and the selling price, how much the output is you get for selling your output. And so in many cases that comes through human labor. For example, if you buy a computer and then you spend the next year writing a piece of software that then you sell for $1 million, that was you added that value to it through your human creativity and ingenuity. But what happens if somebody else bought a computer and used an AI program to create the same $1 million piece of software? That value is still being created. But under our current tax structure, generally it only gets taxed if it's income. And so if there's no individual who is earning that $1 million and paying an income tax, then that value isn't always recaptured. And the point of the tax is to sort of reinvest capital in our society. And so as we see more automation and more development, more harnessing of artificial intelligence to produce value in our society, the value added tax will capture that value and make sure that we're able to fund society to do the things that we want to do, those 5 duties in the Constitution. Much of the legislative language in the subtitle comes from H.R. 6110. It was legislation that was proposed by Paul Ryan back in 2008 as part of a really broad tax restructuring package. And his proposal set up a more traditional value-added tax like they practice in Europe. But what we have in this section is a subtraction method value-added tax. How much did you bring in? How much did it cost you? And the difference is the value that you get taxed on. One of the reasons for that is while many states do have a sales tax, not all states do. And so by utilizing a subtraction method value added tax, it doesn't add an additional requirement on those states. And it makes the tax, makes it more inclusive as part of the overall business profits and less a per item fee. So yeah, I guess just to talk briefly about the larger purposes of the value added tax is as you are successful as a business owner, as a business entity, as a company, then the 12% is paying something back, because all of our accomplishments, all our success, it's built on the achievements of the people who came before us. We have such a great country today because of all the hard work that our ancestors put into it. That's going back to Alexander Hamilton and the first Bank of the United States, and directing investment into productive capacity for the United States. That's how our economy is paying the dividends today that will be reinvested in America as through universal basic income. If you think about some of the biggest and most valuable companies today, say Amazon, for example, right? Amazon's business model rests very heavily on investments by others, right? The entire interstate system, the system of roads that allow them to deliver packages all across the country. Without those things, Amazon wouldn't be able to function. the infrastructure of the internet and so on and so forth. All these things are connected. And so the value added tax takes a percentage of the profit and can use it to reinvest back into building a better America. So with that, Mixed Chair, I think that concludes my testimony for section 451 before we get into the real meat of the value added tax.
Yes, thank you. Yeah, a couple questions. You had mentioned doing subtraction method rather than implementing it at the point of sale because there are states that don't have sales tax. You don't want to add that extra burden. But the vast majority of software that is used to make financial transactions, including between businesses, already fully supports consumption taxes in their software. So I don't see how it would really be any kind of major burden on those businesses to implement a value-added tax at the consumption level, or like at the transactional level, rather than doing an overall subtraction. Can you speak to that?
Yeah, no, thank you for the question. So some of the other issues with the European value-added tax, right, is everybody, when you buy something, you pay the value-added tax on it, and you get a receipt. And then when you file your taxes, you go through all your receipts and you write down how much you paid on how much value-added tax you paid, and then you subtract it from what you've collected. And so there's all that extra paperwork and burden. I spent years as a general contractor, and so I would have shoeboxes full of receipts at the end of the year of all of the purchases and things that I had made. And so a subtraction method value-added tax lets me just simply keep track of what my expenses were and what my how much I paid out, and simplifies things that way. One of the other issues is taxes. Taxes can be a controversial thing in the United States. People can get upset and angry about taxes sometimes. And so if you put this on as a point of sale that shows up on your receipt, then that can be a point of conflict, whereas a tax that's incorporated into the normal operating expenses of a business de-escalates that potential for conflict. And so that is one of the reasons that subtraction method value-added tax would raise less controversy in the United States, I think.
Thank you. Will a VAT cause an inflationary or deflationary spiral?
It will cause some inflation, as so in the finding, the Congressional Research Service concluded it would be a one-time increase in the country's price level. And I got a chart. Let me see if I can share this here. And so Japan, this is a chart of Japan's inflation rate over the last 10 years. And so their inflation was very low, and all the economists said, oh, you got to get your inflation up to 2%. That's a healthy amount. And so in 2014, they bumped their value-added tax rate up from 5% to 8%, purposely trying to spur some inflation. And as you can see, in 2014, they did that 3% bump did correspond to a 3% bump in prices. But then once that got baked into the system, it went right back to where they had been before, and it didn't cause an ongoing issue. And so that's exactly what we should expect here in the United States, is a one-time bump in prices. There's been some research in Europe where, as there have been increases in the value-added tax, that they found that sometimes as little as 55% of it ultimately gets passed on to the consumer. That but businesses who want to stay competitive sometimes will absorb some of the costs in order to keep their prices low. This is another advantage to the subtraction method value-added tax that a point of sale tax wouldn't have.
Thank you. And will a VAT discourage business growth?
No, I don't think that it will. That I don't think that people will feel, I'd be happy to work more if only I could, if only I wasn't paying as much tax. Because remember, this goes hand in hand with universal basic income. We are creating, we're going to be creating new demand for goods and services through universal basic income. And so if you're a business owner or a would-be business owner, there's this money circulating out there. And so you've got, you want to get your bucket and see how much of it that you can scoop up. And as we've talked about, so many other countries around the world already use the value-added tax, and they have productive economies as well. I don't see this as discouraging business growth.
Thanks. Yes, just replying some requests in the comments. They're not questions for the hearing though. Yeah, so seeing no further questions, section 451 is assigned to the subcommittee on findings. I'm looking at section 452 and it adds a new chapter to the Internal Revenue Code with 5 subchapters and a total of 27 sections. Would you be willing to stop and take questions between each subchapter to make it more manageable?
Yes, I think that's a great idea. Section 452 does a lot of heavy lifting.
Thank you. You may proceed to section 452.
All right, section 452 is the value-added tax. And as you said, it creates a new chapter in the Internal Revenue Code, chapter 7, with 7 subchapters. And the first one is the imposition of the tax. I'm going to go ahead and share my screen so we can look at this a little more directly. And the first chapter is the part that actually imposes the tax. The framework for this, I remember I took computer programming back in high school many years ago, and the computer programming teacher was like, when you get good at this, your actual programs are just going to be a few lines long, and everything else will be done within subroutines. And that's kind of the scenario that we've got here. So I'm going to do some of this out of order. The definitions are where a lot of the heavy lifting is. And when we get to the part where it actually imposes the value-added tax, is just a few sentences long. And then there's the tax exempt organizations. So I'm going to kind of work my way backwards through Subchapter A and start with the voluntary value sharing provisions. So this would create section 1604, voluntary value sharing. And we talked about it a little bit with the Treasury dollar bills and with the American Union Jobs Program. And voluntary value sharing, what it does is it allows companies to pay a higher tax rate, higher than that 12% value-added tax, into the Treasury. And that money then would be used to pay down the national debt. So that that would pay down the national debt. And that amount at the end of every fiscal year, the Secretary of the Treasury would report how much money had been generated. And sorry, at the end of each fiscal year, the Secretary will report how much money would be generated through voluntary value sharing. And then it would be distributed to all citizens, essentially as sort of a year-end bonus, and in December of every year. Just, I guess, to clarify, we talked about some of the different kinds of accounts that the U.S. Treasury will be setting up for citizens versus guardians. And so if you have a child who's a citizen, their guardians would get legal guardian. If they have legal guardians who are not citizens, they would collect the child's universal basic income. But in the case of voluntary value sharing, it is divided only among citizens and in equal amounts. So every man, woman, and child who is a United States citizen would get an equal share of this voluntary value sharing amount. And why would companies do this? And there's a couple of reasons that they would. One would be could be good public relations, sponsoring a year-end bonus for the American people. It could be done to apologize for when companies have made errors that it's a way of not just saying they're sorry, but doing something that would benefit the American people financially to address some of the harms that they may have caused. And also, as we're seeing now with oil companies making these huge windfall profits over, over speculation, this is an opportunity for them to say, yeah, we made some extra money. We're going to give some of it back to the American people. Create this voluntary value sharing creates that mechanism to do that. And so the public relations aspect comes of it with an annual report put out by the Secretary of the Treasury that will identify which business entities voluntarily contributed extra tax dollars. And so they will publicize a list of the 200, there'll be a publicly searchable database so that you can see any companies that have participated, and then publicize a list of different size companies, those with gross profits under $1 million, between 1 million and 100 million, and those greater than or equal to 100 million, and rank them in order of their contributions. So of these companies with gross profits over $100 million, because there's a smaller amount of those, if less than 200 participate, the secretary will still fill in this list of 200 with the companies that made the largest profits and with a big fat 0 next to their name. So it'll be good publicity if they're going to appear on the list anyway, to voluntarily share some of their money with their profits with the American people. And so that's the basic mechanism of voluntary value sharing, and how that'll work for paying down the national debt and returning it to the American people. All right.
It's a good time to pause.
Sure.
Yeah. So just a ballpark estimate. How much do you expect this to actually be taken advantage of, like realistically? Do you have any kind of estimate as to what this bonus might look like for Americans every year? No.
This is one of those things where maybe we'd like to see companies compete, right? Who's going to donate the most? Facebook, Google, Uber, let them, who wants to be top on the list? And by forcing them to compete, hopefully we will all be the beneficiaries of that. But no, I don't have any specific estimates.
Will there be, so the Treasury would be publishing this list. Is there a plan to do more than just publish, like have some kind of media or advertising campaign just to better put it in front of Americans' eyes, so that way they really see that this is happening?
Well, I imagine if you were a business who appeared on the list, you would want to promote that as much as possible. That, look, come, you could spend your money at coffee shop A or coffee shop B, but if you come to coffee shop B, we're going to donate an extra 10% of our profits back to the American people. So come shop here instead. That's sort of the goal, is create a mechanism where companies can do these good deeds for the benefit of the public, instead of just thinking for themselves. So once the framework's in place, we'll see who uses it and how it works. But since we're setting up this public payment infrastructure through Treasury accounts for everyone, now we have a way to that we can distribute benefits to all Americans.
Fantastic. Proceed.
All right. So now let's I'm going to scroll back and we're going to hit section 1602 and just show my screen again. All right, so this is the real meat of the value-added tax. Just a value-added tax is imposed on business activities in the United States by a business entity every taxable year beginning January 1, 2024. If you remember, as we talked about the digital treasury accounts and the American Union Jobs Program, it's estimated that it may take 6 months to get those set up, which means that UBI would hopefully be starting by the middle of 2023. So months and months before the value-added tax goes into effect, people would be able to would have money to spend before the tax goes into effect. The tax is 12% of the gross profits of the business entity. And again, before this goes into effect, the secretarial right rules, guidance, regulations, that sort of thing. So this is the value-added tax is applied to gross profits. And so section 1603 relates to tax-exempt organizations. So this doesn't apply to nonprofits. They will still pay the value-added tax when they buy goods and services. If this was I guess I'm not sure how it works in other countries, in Europe or whatever, if nonprofits and things like that are exempt from the value-added tax when they make purchases. But this is another reason to use the subtraction method so that it's lumped in there, that nonprofits are still paying the value-added tax and contributing back to the economy that way. And 1603 clarifies that it can apply to things like colleges and universities if they do vending, if they're doing things specifically for the production of income from the sale of goods or performances of services, that they can be subject to the tax based on that. All right, and so now let's break down exactly what the value-added tax, what it does. What are all these definitions? And I want to start with what is property as it relates to this. Property means a product for purchase or sale, and does not include real property, which would be like real estate, unless specified or clearly be applicable in a certain context. So property means goods, things that you purchase in the store. What is the business activity that the value-added tax is applied to? Business activity means the sale of property, the sale of services, the leasing of property, the development of property or services for sale, but it doesn't include things like paying it does like an employee's work or casual or occasional sales of property by an individual. So if you sell your 2020 pickup truck for $30,000, that would not be a business activity that would be taxable because it's an occasional sale by an individual. The value-added tax applies to business entities. Who are business entities? Business entities are any corporations, unincorporated associations, individuals, partnerships, anybody doing business, with a couple of exceptions. One is government entities doing essential government functions. Think of the Department of Motor Vehicles or things like that. Those would not be subject to the value-added tax. And the other part of this is a safe harbor for small businesses. Business entities do not include an entity whose taxable receipts are less than 3 times the basic wage. So $15,600 a year, 3 times that is $49,800. So if your taxable receipts are under $50,000, then you are exempt from the value-added tax. If you're a small business just starting out, this burden isn't on you until you're making 3 times as much as the basic wage. And so this protects, all the kids doing their lemonade stands or mowing lawns and things like that, not be subject to the value-added tax. All right, the next definition, this applies to the gross profits. What are gross profits? Gross profit means for a taxable year, the amount by which the taxable receipts exceed the deductible amounts. So what are the receipts? What are the things that we count as sales? Taxable receipts includes if you're in a gambling business, people buying tickets and things like that. It includes in-kind receipts. It includes, does not include any taxes that are separately built into the price of things. So if you're selling something that has a sales tax, and you collect the sales tax for a state, the sales tax itself is not included as a taxable receipt for your accounting purposes. Financial receipts, performance of services, kinds of services that included in taxable receipts, including renting real estate, doing performances for entertainment purposes, advertising. If you sell advertisements, Google, we're looking at you. That is a performance of service, and that is a taxable receipt. And what's not included in taxable receipts is exports. This is a tax, this is an American tax that we still want to remain competitive in the world. And so exports from the United States, things that you sell outside the country, would not be subject to the value-added tax. There is one exception to that, unless the exports are subject to Chapter 39 of Title 22, which is the Arms Control Act. If you are selling bombs and other munitions and weapons of war outside the United States, a strong argument to be made that you are not adding value, and those sales will be subject to the value-added tax here in the United States. And in such cases, if you sell them to the government, who then exports them and uses them outside the United States, that is deemed as they would still be taxable. They wouldn't be exempt. All right, that's so those are what taxable receipts are. What about?
Can we pause?
Yes.
Fantastic. Okay, so we are taxing gross profits. A potential concern could be that large corporations may then decide to just, before the end of the year, take what their profits would have been and just funnel those into executive bonuses so they don't appear as gross profits for and then they just end up in the hands of individuals
I
the
think you're going to be
executives
very
who
interested
have-
in the definition of business purchase.
Okay. Oh, right. Because I mean, if it's reported as income, but then they would actually have to pay tax on the income too, because most of the time they don't report it as income. But do you see where like my head is cranking? Can you help me
Sure.
sort through this?
Yes. So it's gross profits. So it's your taxable receipts minus the, well, these are the deductible amounts, which are the business purchases. And so when we, yeah, if I can continue and into the definition of these things, I think it'll address some of your concerns. But yes, I see where you're coming from.
Gotcha. So labor is not a deductible. It does not deduct from gross profits. Okay.
May I proceed?
Yeah, I was trying to think. I think there was one other thing. There was. I'm blanking on it. I'll figure it out. Go ahead and
Okay.
proceed.
All right. So again, gross profits are taxable receipts, which we just covered, minus the deductible amounts for the year. So deductible amounts means the cost of business purchases, excluding anything such as that's exempt, like exports. All right. So what are business purchases? What are the allowable deductions? And so here's what we've got. Business purchases include purchase of supplies and inventories, the things that you use to make the product that you sell. Purchases of services from independent contractors. Now, independent contractors have to be business entities in order for this to apply. So if you are a business that is trying to hire, say, delivery drivers at low wages, and those delivery drivers are exempt because they're not making $49,800 a year in gross receipts. They're exempt from the value-added tax. Then they are not. Then it's not a purchase of services that you can deduct. You would be responsible. You wouldn't be able to deduct those amounts unless somebody else is paying the value-added tax on those. Business purchases also include the purchase of financial intermediation services, which we'll get into later. Imports. So if you're importing something, it does not include the import tax, just the underlying value of the price of the good or services. Business purchases include any payouts. Again, if you're a gambling games of chance, your payouts count as business purchases. But here's what business purchases do not include. They do not include compensation expenses for an individual. So this is the part where if you're adding value to the company, if you bought $1,000 worth of raw material and sold your product for $1 million, and you say, oh, well, I'm paying myself $900,000 and then the rest is profit. No, compensation expenses are not a business purchase. Does not include the purchase of or rental of real property. So again, if you made a lot of money in your company and you're like, hey, what if we just buy a bunch of real estate and then say we don't have any profits for the year, so we don't have to pay any taxes? Purchase or rental of real property is not a business purchase. Same applies to purchase or rental of capital equipment, property outside the United States, services performed outside the United States. So if you are subcontracting with a business entity overseas, then that doesn't count as a business purchase that you can deduct from your gross profits, unless you treat it as being imported into the United States. And some other things as far as taxes. Paying taxes doesn't count as a some purchases do not include the the taxes does not include political contributions. You can't write those off as a business expense, and expenses related to advertising. Advertising doesn't make advertising is not part of the inherent the product or service that you're selling. It's a separate thing. So I think those are the main definitions in here that pretty much lay out the framework. Everything else in here I think is pretty self-explanatory stuff about the Internal Revenue Code and things like that. And so with that, I think, Mixed Chair, that'll conclude my testimony for Subchapter A, and now I'd be happy to answer any further questions.
Fantastic. Yeah, you got right to the part that set my mind straight. Thank you. I do remember the other thing I was gonna ask about. So we had this line drawn at $49,800. But if an individual brings in 52 grand, all of a sudden the 12% applies to that entire 52 grand. Is that correct?
That's correct.
Wouldn't it make more sense just to exempt the first 50 grand and then anything above that gets taxed? So that way you don't screw over those businesses that are just right on the edge?
Maybe. I'm not 100% sure. The other part is that the safe harbor will, as we talked about, the universal basic income will be tied to inflation. And so as the basic wage goes up, the safe harbor will increase too. As you know, this is sometimes a problem we have by writing fixed dollar amounts into the law. And so the safe harbor will increase as well.
Right. So, I mean, replace the term 50,000 with the safe harbor line, whatever that safe harbor line is. If you come in just above it, I could see that then all of a sudden having to pay 12% on all of that could be like problematic for a small business. Whereas if you only need to pay 12% on that last 5 grand or whatever it is, may be much more reasonable for a business of that size. And when we're talking about companies like Apple and Amazon, there would be a negligible difference.
Mm-hmm. Yeah, I think that's might be something we could look at with the subcommittee. I guess the other part of that is, so remember, so if you're a small business owner and you're an independent contractor, right, and you work for Amazon and Amazon pays you $48,000 a year, then Amazon is responsible for covering the value added tax because you're not legally a business entity. Which then is, so then what happens if, I guess where I'm going is, so somebody's already covering that tax on the first 50,000. And so if you create a safe harbor, I feel like you could be creating a loophole where you allow separate business entities to each deduct $50,000 of their gross profits, where you'd create a financial incentive to split it up as into a bunch of different entities who each be able to deduct 50,000. But anyways, we can look at this in the subcommittee.
All right. Seeing no further questions on Subchapter A. Subchapter A will be assigned to the subcommittee on taxation. You may proceed.
All right, thank you. All right, we'll move on to Subchapter B and the general accounting rules. I mean, so now that we've kind of established this general rule of a 12% value added tax, we've got to flesh out some of the details, and that's what these other chapters are for. This is the kind of stuff that the lobbyists get paid big bucks for, is to sit there in Congress and in Washington and make sure that there's loopholes for their clients. But the Phoenix Congress model turns it around and says, look, we're gonna write the details outside the swamp of Washington and make sure that it's all done openly upfront, that everybody knows what we're getting. And it's important for us to actually get into these details here. So most of these sections are very short. I'll just touch on each of these briefly. Section 1611 is general accounting rules, which is basically the default is to use the accrual method, accrual basis for bookkeeping, which means that business purchases, it's when you incur them or when you incur them or when you send out a bill, even if the other company hasn't paid you yet. When it's on your books, that's when you treat it as an expense or as income. Section 1612 says that the use of cash accounting method is still permitted. There are some businesses that use it. It's unusual, but if it's currently permitted under regulations, then you can still do it, and the secretary will have other regulations if needed. Taxable year, we touched on this a couple times in the previous subchapter. Taxable, we're going to start this January 1st, 2024. So want to get everybody on the calendar year as a taxable year. As you probably know, the United States government uses a fiscal year that is not the calendar year, but for other businesses, try and push them in that direction for simplicity's sake. So define how that works. If they are on a fiscal year that is not the calendar year, then it would set up a short, a short taxable year that would end December 31st. So if you were on the same calendar as the federal government and start your taxable year in October 1st, then you would have a short taxable year in 2023 where that year would end on the end of the calendar year and then start a new one on January 24th, 2024. Business entities that use a weekly, do their accounting on a weekly basis instead of monthly or yearly, would still be able to do that if they're permitted under existing rules to have a 52 or 53 week taxable year. And there's an anti-abuse rule, so you can't abuse any loophole with taxable years that don't line up with the imposition of the value-added tax. Section 1614 deals with long-term contracts. These are contracts that take place over multiple tax years, and it sets out when contractors and things, how they'll treat these things. Section 1615 deals with adjustments and refunds. If you've put a sale on your books and then the guy never pays you, you can go ahead and make adjustments if it's even if it's in the different taxable year. Bad debts, same thing. If you write off a bad debt and then you actually end up recovering it, then you got to treat it as a taxable receipt when you collect it. So those are some of the basic accounting rules, and I think that concludes my testimony for Subchapter B.
Thank you. Seeing no questions, you may proceed to Subchapter C.
All right. Okay. Subchapter C is dealing with financial products and services. The value-added tax is pretty straightforward when we're talking about something tangible like a car or something like that. But what about financial services where like the business entity is a middleman? And so that's what Subchapter C deals with. Once again, we got the definitions in section 1621. I think we'll just I'll jump back up to them as they're appropriate. But 1622 deals with the sort of the general rules that gross profits, how you calculate gross profits. Instead of taxable receipts, we use the definition of financial receipts. and include financial expenses as business purchases. So let's look at what financial receipts. Financial receipts means everything, and financial expenses includes paying out, like if you're an insurance company, paying out for. Sorry, there's a quotation mark in the wrong place here. It's distracting me. Financial expenses includes payment on principal and interest, and things like that. Some businesses they do more than one of these things. You might think of like a car dealership or something that sells physical products, but also, makes loans and stuff like that. And so this would, if there's a separate business activity, section B here says that that'll be considered a separate business activity, and it'll be considered a separate entity with respect to such activity. So that's how that would break out for businesses like that. We've got special rules for banks in section 1623, clarifying again what those financial, kind of defining what is a bank, what their financial receipts would be. So all their taxable receipts, the interest that they're making, anything that they're making on the sale of loans, any discount points, any other explicit fees, those are all financial receipts that would be subject to the value-added tax. And then as far as their expenses, that's things like the interest. And for when it comes to foreclosure property, making sure that they take that into account for their gross profits. And then our definition here of bank, this kind of includes a lot of the things that we covered in the Treasury dollar bills. But if a bank is engaged in significant amounts of activities other than those described in paragraph 1, it should be considered as a separate business entity with respect to other activity. So if you're a bank who does lots of buying and selling of other products besides financial services, then that's to be treated as a separate taxable entity. 1624, pretty much kind of the same thing, treating insurance as a financial intermediation service. And if you get inconsistent results, it's inconsistent with the territorial approach of the value-added tax, then the insurance company can ask the secretary to apply a different set of rules. Section 1625 deals with financial pass-through entities. These are legal entities that are like sole proprietorships and things like that, where the money generally goes to individuals as opposed to a corporation. And so financial receipts, if you're putting money into your business, that can be included as a financial receipt. And then those distributions, if you take money back out of the company for yourself, then that can be those things count as receipts and expenditures. Yeah, I think that concludes my testimony for Subchapter C, and happy to answer any questions.
Thank you. Do credit unions count as banks under this subchapter?
Yes, they're included as long as they're subject to state or federal authority. Then yes, they're included.
Fantastic. Seeing no further questions, you may proceed.
All right. Okay, Subchapter D, we got the other half of this, the import tax. So I mentioned earlier, this is the value-added tax applies to business entities in the United States. And so to keep companies outside the United States, keep us on a level playing field. If we import their goods or services, then they will be subject to a 12% value-added tax. Not a value-added tax, sorry, an import tax. So section 631 is the general rule. 12% tax equal to the customs value of the property that's coming in. There is an exemption for personal consumption. So if you're importing something for personal use, it is not subject to this tax. This is for sale or retail by a business entity. That's the purpose of the import tax. It also does not apply to petroleum, gas. These are no extra tax on those through the import tax. We will talk about it a little bit though in the carbon fee next week. And the president also has the authority by executive order to lift this import tax on commodities or products that they determine to be in short supply and vital to national security. Section 1632 is the imposition of the tax on import of services. So again, 12% tax. And how is it, again, if you hire a computer, physical objects are one thing, right? But for services, if you hire a computer programmer who's working in the Midwest, they, as a business entity, are going to pay the 12% value-added tax. And so if you hire a computer programmer out in Asia and you import their services, then you would be responsible for paying that 12% import tax to keep the market at a more level playing field. The liability for this tax is on the person who receives it. This is different than the value-added tax, where the person who sells the services is responsible for paying it. If you're importing it, then the person who receives it is responsible for paying it. What does import or export mean? It's defined by where it takes place. It's important because remember, exports don't count as taxable sales. So if you're a business entity selling you're the programmer in the Midwest and you're selling your services to a company in Europe, then that's not an export. It's not subject to the value-added tax because you are exporting your services. If they take place, the entire benefit of the service will be realized outside the United States. Services acquired from a service provider that does both inside and outside the United States. We've got some mild the rules around that. Explaining how it's essentially where the services are reported as being provided on the invoice is how they're treated. Section 1634 is international transportation services. So if you are, you got a small business, your business sells things overseas. Again, the sales that you make overseas are not taxable. And taxable receipts also do not include receipts from the transportation property. So you sell a $100 widget and you pay FedEx $20 to ship it over there. That the cost of the transportation is also not subject to the value-added tax. What about more complicated things like taking international flights? Is that a service inside or is it outside the United States? And so these rules say you can base it on the origin. So if you're in the United States flying to the outside, then that would count as a taxable receipt. If you're flying back in, then it is not. And then there's also a mechanism here where the secretary can simplify it and say, look, any international flights, just count half of it as receipts. Section 235 deals with international communications. Basically, if you're making overseas calls, it's just a business expense. It's treated as provided at the point of origin of the communication. So if you're in the United States making a call, it's not an import or an export. And this includes all sorts of things like voice over internet protocols, text messaging, video conference services, all those kind of things all fall under this section. Insurance services are treated as provided at the location of the insurance company. So if you are an American business who is insured by Lloyd's of London, for example, then you are importing an insurance service, and there will be a tax on the premiums that you pay. But any benefits that you receive would not be subject to the import tax. If it's the other way around and you're an insurance company in the United States providing services outside, then it's an export. There's no tax on premiums that people outside the United States send to you, but those payments don't count as business purchases either. In section 1637, it kind of just says that it's complicated and the secretary shall prescribe regulations on the location of banking services and the extent to which such services are to be treated as imported or exported. So they'll deal with this through rules. Next Chair, I think that concludes my testimony on Subchapter D, and I'd be happy to answer any questions.
Fantastic. Yes, you had mentioned executive order, or that the president could issue an executive order for commodity items or anything that we're short for. Is there a sunset clause attached to that, so that the president would be required that the executive order could only last a certain period of time, and that the president would have to re-up it every once in a while, just to ensure that as an accountability measure?
No, there is no mention of a sunset clause there.
Is that something the subcommittee may consider adding?
Be happy to look at it and work on it with the subcommittee. Sure.
Fantastic. And then a question about the import tax on services. So for example, if I hired someone on Fiverr outside of the United States to design some kind of like literature, campaign literature or something, would I have to pay the import tax?
So only if you're a business entity. If you're just doing, something small, something local, that you're not a business entity, no, then it doesn't apply. But if you are a business entity, with that $50,000 in out of that safe harbor, then yes, that would be yes, you'd be responsible in that case.
Seeing no further questions, you may proceed to Subchapter E.
All right, and we're in the home stretch here. Subchapter E. This is just some rules and rules for administration, consolidated returns. And so in subchapter in section 1641, it says that until the rules get updated, just the existing stuff sort of applies. It applies to individuals. If you have to file business tax returns with your individual returns, and you're subject to estimated taxes already, you'd also be subject to estimated tax rules under the value-added tax. 1642 is consolidated returns. If you're a business with many legal entities, you can file consolidated returns. You just have to be consistent about it. So if you have a lot of vertical integration, and you produce the raw materials and then turn them into finished products in your factories. You just have to be consistent about where you pay the value added tax, whether it's on the from start for the cost of your things at the very beginning to the actual sale to the end consumer, or if you report them for each individual legal entity. So just be consistent. 1643 clarifies that the seller is liable for the tax. Again, if you're generally required to pay estimated liability for a taxable period, the same thing applies here. And in general, that taxable period is a quarter, but you could do it on a monthly basis as well. At the point at which the tax is triggered is when you receive the payment for it. The earlier of when you receive the payment or when you record the income from the sale. And in the case of imports, it's when they actually get to the United States or taken out of the warehouse after arriving in the United States. 1644 is just informing the secretary of any changes in your business entity if it's going to affect how the value-added tax is administered. And then 1645 is the standard. Secretary shall prescribe such regulations as may be necessary to carry out the purposes of this chapter. And Mr. Chair, I think that concludes my testimony for all of section 452, and I'll be happy to answer any questions. I'm very glad that we split that up into individual subchapters.
Fantastic. Yes. Do you foresee the value-added tax encouraging or incentivizing companies to become more vertically integrated?
It shouldn't matter. If you, for example, you own a forest and you chop down a tree, sell the tree, and then turn that tree into lumber. Whether it's the price that it ultimately gets sold for, subtracting whatever your original input was. So if the company that chops down if you own the company that chops down the tree, then it's not sort of in the same way that the value-added tax works in Europe, right? Where everybody's value-added tax kind of gets passed up the chain. And so if you're a vertically integrated company, then you're just responsible for all those links in the chain, as opposed to if you're not a vertically integrated industry, then you'll be paying to the separate businesses at each stage of production. So it still adds up the same. I don't think there's any incentive to be more vertically integrated.
Seeing no further questions, all of section 452 is assigned to the subcommittee on taxation. You may proceed to section 453.
All right, thank you. These next three sections are pretty short. Let's see. So section 453, it just requires that the secretary give Congress a legislative proposal to harmonize everything in 452 with the existing Internal Revenue Code and offer any statutory definitions that are needed. And that's what section 453 does.
Thank you. Seeing no questions, section 453 is assigned to the subcommittee on taxation. You may proceed to section 454.
Okay, and section 454 is just sort of lays out what companies are supposed to do until Congress actually enacts that legislative proposal, and it just sets out the basic rules of saying how these amendments should be treated until that time. And that's what section 454 does.
Thank you. Seeing no questions, section 454 is assigned to the subcommittee on taxation. You may proceed to section 455.
Okay, and section 455 is once again just the effective dates, saying This goes into effect January 1, 2024, with respect to tax years beginning on that date. And once again, reiterates there's no cheating if you're a business with a 52 or 53 week taxable year, that you've got to, you can't restructure things in a way to try and create a loophole. So that's all that section 455 does. And happy to answer any further questions.
Seeing no questions, section 455 is assigned to the subcommittee on taxation. I'd like to thank the delegate for his testimony.
Thank you, Mixed Chair. That was a long hearing, but it's important to know that the details are there. This isn't a nebulous proposal that candidates for office often make. The Blueprint for a Better America is a very specific legislative package, a very specific proposal for how we can end poverty, end mass incarceration, and the endless wars.
Thanks. Yes. The next session of the Phoenix Congress will be held on Thursday, March 24th. We will review sections 461 to 504 relative to the value added tax. This hearing is adjourned.